The crypto market often appears as one giant golden monolith, but look closer and that idea cracks apart. Treating all digital assets as identical leads straight to misallocated capital. This table breaks the digital asset ecosystem into its three true distinct categories: Bitcoin, altcoins, and stablecoins. Each category was engineered to solve a specific financial problem. Matching a specific asset to your goal provides capabilities traditional finance lacks. Picking the wrong one leads to disaster. An investor might park house down payment savings in a volatile token, only to watch half the value evaporate a week before closing. Survival in digital assets requires mapping a token's underlying architecture to your specific risk tolerance and goal. Decentralization means distributing network control across thousands of global nodes, ensuring no single entity can censor or stop your transactions. The trade-off for that level of security is immense computational energy. Running operations on an industrial scale makes the network slower than traditional payment processors. Bitcoin is the original decentralized asset. It absorbed that trade-off intentionally because it was engineered specifically to be a digital store of value. This chart shows how mathematical scarcity works. By design, Bitcoin has a hard-capped supply limit of exactly 21 million coins. While the fiat supply expands exponentially upward, Bitcoin's mathematically enforced ceiling creates a long-term hedge against central bank money printing. But its rigid security architecture comes at a cost. Bitcoin is single-purpose. It cannot execute complex programmable contracts, and despite its properties as an inflation hedge over a multi-year horizon, the asset still suffers from moderate, sometimes painful macro market price fluctuations. Adopting a volatile asset as an everyday currency for basic goods creates massive real-world friction and public pushback. When forced to adopt it, citizens march to the mat of total rejection. You cannot buy groceries with an asset that swings wildly day to day. Bitcoin is optimal for long-term wealth preservation, but its lack of flexibility and near-term volatility severely limit its immediate transactional utility. That limitation gave rise to altcoins, the innovation layer built to execute programmable smart contracts. These assets operate on different blockchains to enable diverse functionalities, spinning up geometric webs of decentralized finance lending and high-speed applications. This quadrant charts the extreme risk and reward profile of these assets, scattering them far out from the relative stability of Bitcoin. But the core trade-off here is steep. Gaining this advanced utility and speed almost always requires sacrificing true global decentralization. There is a hidden risk of centralized control. A small group of founding developers often hold disproportionate power over the network's rules in its treasury. This concentration of power leads to extreme price volatility. Projects can surge exponentially in weeks or collapse to zero in an afternoon. Because of this volatility, purchasing an altcoin behaves much more like investing in early-stage venture capital than holding a currency. They are powerful speculative instruments for investors seeking outsized tech growth. They are completely unsuitable for anyone prioritizing capital safety. To eliminate price volatility entirely, you have to look at stablecoins. Their primary function is straightforward: provide the speed and borderless transferability of a blockchain without the terrifying price swings. This diagram splits the two ways developers achieve this. The asset-backed model strictly ties digital tokens one-to-one to fiat currency in a bank reserve. The algorithmic side relies on mechanical code and market incentives, rather than cash, to dynamically maintain a $1 peg. Both models carry risk. If the centralized fiat reserve is mismanaged, or the algorithmic code is exploited, the token loses its peg. When algorithmic projects fail to hold that dollar value, the collapse is sudden and absolute, usually ending in a grim public post-mortem. The core trade-off is clear. To remove market volatility, you must completely trust a centralized issuer or an unproven algorithmic mechanism. Stablecoins are the ultimate utility tool for seamless, borderless transfers, but they require constant vigilance against counterparty failure and forfeit all investment upside. The underlying technology behind these digital assets only truly matters once it finally locks on to your specific individual financial intent. This flowchart translates that intent into a decision matrix based on 3 distinct user profiles and their primary goals. For the wealth preserver, the primary intent is long-term inflation protection. This points directly to Bitcoin. But to succeed, the wealth preserver must be psychologically prepared to endure significant macro market corrections without panic selling. The speculator is hunting for outsized returns and betting on Web3 tech adoption. This intent points down the altcoin path. This requires actively researching development teams and fully accepting that the chosen project could go to zero. Finally, the utility transactor wants instant, borderless funds transfer without exposing their capital to price swings. Their tool is the stablecoin. This path requires vigilantly monitoring the issuer's reserve audits to ensure the asset maintains its fiat peg. Success in digital assets depends on matching a token's underlying architecture to your exact risk tolerance and financial objective.